Welcome back to Sunday Blueprint, where we build wealth that lets you sleep soundly on Monday morning. Last week we automated our cash sorting to escape lazy banking traps, but today we need to tackle the silent siphon sitting right inside your wallet. Credit card companies design their products to function like a reverse mortgage on your future. They count on compounding interest working against you. Most people think wealth is about picking the right stock, but it is actually about plugging the invisible leaks in your everyday bucket. Let us look at the actual math behind what is happening when you carry a balance. By late 2023, average credit card interest rates in the United States peaked above 20%. Think about that for a second. 20%. No legitimate business investment consistently yields 20% year after year, yet millions of households pay that exact rate on everyday expenses. We are not here to pinch pennies until they bleed. We are here to architect a life where work becomes an option, not a life sentence. But you cannot build a sturdy financial house on top of quicksand. High-interest debt is quicksand. Let us run a very standard scenario that happens in millions of American households every single month. Imagine carrying a $5,000 balance at a 22% annual percentage rate. If you only make the minimum payments required by the issuer, what actually happens? You might feel comfortable because the monthly cash outflow feels small. But that comfort is an illusion engineered by the bank. That $5,000 balance will take more than 15 years to clear. And the total interest paid? Over $8,000 on a $5,000 principal. You end up paying more than $13,000 for $5,000 worth of goods or emergencies. That is not a service. That is a structured wealth extraction machine. The credit card companies win twice. They profit when you buy, and they profit exponentially when you delay paying. Every month you carry that balance, a massive chunk of your hard-earned income vanishes into thin air. It buys nothing. It creates no equity. It builds no foundation. It simply feeds the beast. When I worked on Wall Street, I saw sophisticated institutions manage risk by ruthlessly cutting out toxic liabilities. We need to apply that exact same institutional discipline to our personal balance sheets. You cannot outinvest a 22% interest leak. No index fund return can reliably beat the guaranteed loss of a high-interest debt trap. So how do we stop the bleeding? We stop paying retail for our debt. There are two primary schools of thought when people finally decide to attack their debts. The first is the debt snowball method, popularized by personal finance personalities. It tells you to list your debts from the smallest balance to the largest balance, regardless of the interest rate. You throw every extra dollar at the smallest balance until it vanishes, then roll that payment into the next smallest one. Emotionally, it feels fantastic. You get quick wins. You cross items off a list. For some people, that psychological momentum is the only way they stay in the game. But from a purely structural engineering standpoint, the snowball method is inefficient. It ignores the cost of capital. It leaves the highest interest debt lingering longer, meaning you end up paying more total interest to the bank over the life of the repayment plan. That brings us to the second approach. The debt avalanche method. This is where the pragmatic, cold math takes over. With the avalanche method, you list your debts strictly by their interest rate, from the highest down to the lowest. You pay the absolute minimum on everything else, and every single extra dollar goes straight toward wiping out the debt with the highest rate. Once that high-rate monster is dead, you take its entire payment and roll it into the next highest rate. Mathematically, the Avalanche method minimizes the total interest you pay. It shortens your timeline. It is faster, leaner, and far more ruthless. It treats your money with the respect it deserves. If you want to build a sustainable financial house, you patch the biggest leak first, not the most convenient one. Now let us talk about a powerful accelerator that can supercharge your Avalanche strategy. The 0% balance transfer card. Many credit card issuers offer promotional periods where they charge 0% annual percentage rate on transferred balances. These promotional windows typically last anywhere from 15 to 21 months. Of course, there is a catch. They usually charge a one-time balance transfer fee ranging from 3 to 5% of the total amount you move over. People often hesitate at that fee. They see a 3% fee on a $10,000 transfer, which is $300, and they flinch. But let us look at the structural reality. If you are currently paying 22% interest on that $10,000, you are paying roughly $180 every single month just in interest. Paying a one-time $300 fee to completely halt a $180 monthly interest hemorrhage is not an expense. It is the best return on investment you will ever make in your life. That transfer fee buys you breathing room. It buys you time. During those 15 to 21 months of 0% interest, 100% of your monthly payment goes directly toward killing the principal balance. Not a single penny gets siphoned off by the bank as interest profit. You go from running on a treadmill that keeps you in the exact same spot to actually sprinting forward down an open highway. Let us trace how this looks in real life. Suppose you move that $5,000 balance to an 18-month 0% card, paying a small transfer fee. Instead of 15 years of misery and $8,000 in extra bank payments, you divide $5,000 by 18 months. That comes out to roughly $278 a month. If you commit to that fixed monthly payment for 18 months straight, the debt is completely gone. Zero balance. Finished. You kept your hard-earned capital instead of handing it over to a corporate lender. This is how you reclaim sovereignty over your personal economy. It is not about luck or secret Wall Street hacks. It is about structural mechanics. You identify the leak, you use the right tool to seal it, and you redirect your cash flow toward your own future instead of someone else's quarterly earnings report. We are building a fortress here, brick by brick. Next Sunday, we are going to take this exact same systematic approach and turn it outward toward your fixed monthly expenses. We will look at how to negotiate your bills down without sacrificing your lifestyle or your peace of mind. Until then, take control of your numbers today, so your numbers take care of you tomorrow. See you next Sunday.